So, good evening. Just wanted to go through some few questions with some of you. I've received a lot of questions on my phone today. Most of you keep calling, asking questions, and I've been busy, so I didn't get time to answer most of you. So I'm just taking this opportunity to answer some of the questions for you. Okay. Now, you were given some assignments and you are supposed to do it. You are supposed to do it and submit. And a lot of people have asked questions in connection with that. The question on acquirer and swallowed. Now, I think in class I made mention that I showed it to you that you guys should go and look at the question on your own. If you have any challenges, you let me know. But none of you bothered to look at it until you were given an assignment. But that notwithstanding, look at it. Now, it's in your handout, but I don't know which page it is. So I just want to use what is in the handout to explain the whole question for you. As to whether there are changes in the question, I'm yet to know. But we are being told that acquirer and swallowed have the following profit and losses for the year ended 31st December. And you have the income statement there. You also have the income surplus account over there, which I think is not different from what you have in the assignment. But the additional information, the one in the handouts, acquirer purchased 16,000 of the 20,000 shares purchased or issued by Swallowed. By the assignment, you purchased 19,000 out of the 20,000, and I think that one there shouldn't be a big deal for you. You know what to do with it. Then the income surplus is still 15,000. Then in the handouts, the income surplus was written off over 5 years. But for the purpose of what I'm going to do, we are going to say that the goodwill has been fully written off for the purpose of what I want to do. So that you understand, when I finish, I'll do the 5 years, then I'll do the other ones. But in your question, you were told that goodwill on consolidation has not suffered any impairment. So invariably, they are telling you that goodwill on consolidation is maintained. So that is the extract from the question that I have put over here. Acquirer bought 16,000 shares. So I asked myself, how many shares is Swallowed having? So Swallowed is having 20,000 shares. So 16,000 out of the 20,000 shares gives me 80%. So acquirer is having 80%. Minority will be having 20%. So straight away, I look at my cost of control account. The 80% of the stated capital gives me 16,000 over here. We're told that the pre-acquisition surplus is 15,000. So 80% of the 15,000 should give you 12,000. So if I do my calculations, I should get goodwill to be 5,000. Goodwill to be 5,000. 5,000. So let me just look at the one you were given. So 19,000 divided by 20,000. You get how much? 95%. So 0.95 multiplied by 15,000. You get 14,250. So 19,000 plus 14,250 give you 33,250. So your credit side 33,250. 33,250. Credit side is greater than the debit side. So you are having a credit balance, and the difference is what you call capital surplus of 250. I now understand why a lot of people are calling me today in connection with this particular information. But you see, in class, we told you that the cost of control account is used to determine goodwill or capital surplus on acquisition. The goodwill account or the cost of control account is not called goodwill account. And so therefore, it is just by coincidence that most of the things you were looking at, you were getting goodwill. So some of you think it is a goodwill account, but that is not it. It is used to determine goodwill or capital surplus on acquisition. So if it is a credit balance, there is what to do. If it is a debit balance, there is what you need to do. So what we have here is called capital surplus. And the capital surplus here is going to be 250. So 33,250, 33,250. So basically, this is what you get for this particular illustration, or this particular illustration you have been given. So that is it. So for the purpose of your assignment, this is what you are going to get as your capital surplus. So because it is not part of my question I'm looking at here, I'll just delete it and move on. Now, the next thing you look at is preparing your consolidated profit and loss account. And in an attempt to prepare the consolidated profit and loss account, you must look at intra-group balances and eliminate them. So turnover, you add that of acquirer and swallowed. That one is straight away, you know how to do it. Cost of sales, you add it to. Gross profit, you add it. Distribution costs, administrative expenses, operating profits before interest and tax. So when you less distributing costs and administrative expenses from gross profit, you get what you call operating profit. Interest payable, 11,000. Profit before tax, 92,000. And tax in that order. There was an investment income of 4,000. Here, you ask yourself, you go to your income surplus account. There was a 4,000 coming from the subsidiary, and you ask yourself where the parent is saying that he has received 4,000 investment income, or it is in the account that there is an investment income received of 4,000. You must find out where that 4,000 is coming from. Now, the subsidiary has declared proposed dividend of 5,000, and we already know that the parent is having 80% in that company. So 80% of that 5,000 is 4,000. So when you are seeing investment income of 4,000, you should know it is coming from the subsidiary. Then you are free to do what? To eliminate it. So it is on that basis we don't have the 4,000 in our workings over here. Now, for those that they will tell you goodwill is written off over a number of years. So let's say we are writing off goodwill for, let's say, 5 years. So it means that for this year that we are preparing the P&L, 1,000 will be written off in this year. But we are not there. We are not there yet. So, for those of you who wanted to understand, that is how we do it. So, for example, 1,000 will appear under the administrative expenses over here for the goodwill to be written off. That is when we are writing it off for, let's say, 5 years. That is the original question in the handout. Okay. Now, once I get my profit after tax, I determine my minority interest, and I've explained how to get this minority interest over here. We said it in class, and I don't think it should be anything difficult for you to do. Then I bring my retained earnings here, and this retained earnings, I already tell you that C working, meaning I showed working how to get this particular retained earnings. So my balance brought forward is 48,000, and that is from this particular side. When you go to the income surplus account, the retained earning brought forward of the parent is 48,000. Then post acquisition surplus, you already know how to get post acquisition surplus, so I'll not waste much time on that. Then goodwill has been fully written off. So the 5,000, we are writing everything off entirely. But in your assignment, you were supposed to maintain it. So nothing comes here for goodwill. And then you balance up the accounts, and then you get this. I have given the breakdown of how I calculate my investment income. That is 80% of the 5,000. I get this. Minority get 20% of the 5,000. So it is this 4,000 that the parent is showing on his account as the investment income. Now, this side of the account, this side of the financial statement can be added to the group profit, just like the way I did. Or you can decide to take it off and represent it like this. You are so correct. So you don't do it like this and still do it like this. No. You can either detach it from the income statement itself, or you can just add it to it, and then okay. So for the acquirer and swallowed question that you were given, this is basically how you are going to solve the particular question. And I don't think it will take you more than 5 minutes to solve this particular question and present it as your solution for the assignment. So based on what I've explained, or based on what I've said so far, I think you should be able to handle that assignment with ease. If you are still finding problems, then you have to go and look for Professor opinion for you. That's just by the way. There is another one too that I told you that my boss asked you people to do it as an assignment. But I don't know if you guys have still done it. So he is still adding the assignment rates. And in due course, he can request for any of them to be submitted. So if you have not done them, kindly go back and go and look for them and do it. So let's look at that particular illustration on page so yeah, this is the example 7. I think we solved it in class. I don't know, but I asked people to go and do it. So that's question 2. This is just the solution to the question. The example 7 in your handout, where you have H and S limited. So we're told that H bought an amount of shares 3,750 in S. So we know that the number of shares in S is 5,000. So if H is buying 3,750 out of the 5,000, it's going to give H 75%. So based on that, H is having 75%. Minority is having 25%. That is my note 1. Note 2. We were being told that there was an investment income, or in the investment income where we considered the investment the parent has made in the subsidiary. He bought ordinary share, then he also bought debenture, 50% of the debenture of the subsidiary. So the parent company is entitled to interest on the debenture, and is also entitled to dividends on the shares. Now, the interest payable by the subsidiary is 500. So when you go to the subsidiary's account, subsidiaries say that interest payable is 250. So what it basically means here is that the 10% of the 5,000, I'm supposed to receive 500, but the subsidiary is saying that he is yet to pay 250, meaning I have received 250 already, and you should know that the interests are paid semi-annually. So the 250 there is half of the interest that has not been paid yet. So with that, I need to recognize it in my account. Then dividend. Subsidiary also declared a dividend of 400, and 75% of the 400, 300 becomes the parent's portion. So therefore, if I want to know my total investment income, then 50% of the 250 that is yet to be paid becomes that of the parent's own. Then 300 of the dividend becomes that of the parent's own, and the total investment income from the subsidiary due to the parents is 425. That's 125 of the dividend interest and 300 of the dividend. Then I proceed to prepare my cost of control account. And in this instance, the total investment made by the subsidiary, by the parent company, is 13,200, which is on the balance sheet. But in acquiring a company or in acquisition, we don't consider the debt portion of the capital structure when we are determining control. we are only looking at the equities. So we are looking at only the preference shares and that of what? The ordinary shares. So if the total investment is 13,200 and he is investing in 50% of the debentures, then the total debentures by the subsidiary is 10,000. 50% is 5,000. So it means that you subtract 5,000 from the 13,200. And whatever is left, which is the 8,200, is the total investment in the equities of the subsidiary. So you get that, then you do the necessary things you have to do to determine your goodwill, and then move on. Then you have your consolidated income surplus account. Before you adjust or you bring your balance, you should know that you were told that H has included the interest receivable from S in his account, but yet to account for the dividend receivable. You should know that the dividend, once it has not been declared, you don't know how much it is, or you don't know how much you'll be including in your account. So technically, the dividend was omitted from the account. So that error must be corrected by crediting your income surplus account and also debiting your debtors account in accordingly to correct that particular error. So we add 300 to the opening balance of the parent, we go and add 300 to the debtors of the parent to correct the error. Then later we do the elimination on the face of the balance sheet. We were told that goodwill has fully written off, so we debit goodwill to over here. Then you go on and prepare your minority interest account, and then you are good to go. From there, you look out for your consolidated balance sheet. The only places where the differences are now is that now we don't have goodwill anymore because it has been fully written off. Your tangible fixed asset, you added 2. Your stock, you add it. Trade debtors, your 5,800 plus the 300 here to include the omission of error into the account plus the other debtors. Then we'll now come and do the elimination of the monies received from the subsidiary. So those things we have explained them in class, and you already know why. This is not the time for me to come and be explaining most of these things over here. Then you have your liabilities over here. That one too, this one was paid to the parents, so it must be taken care of accordingly. Venture also have to be taken care of accordingly. So that is how your consolidated balance sheet would look like. Once you do that, at least you are free to go. Then we also looked at a couple of examples, a couple of items. Yes, I think I also asked you to go and look for, go and solve the example 8 by yourself. Okay. I think I also did that because we didn't get a chance to solve it in class, but I think I did that. And those who have looked at it, it's cool. So I think it's here. Those who have looked at it, you can compare your answers with my answer. If your answer is correct, example 8. So this is the example 8. This is the These are the workings, and I think I even solved it on the YouTube already. But ordinary shares have to be calculated. So for the ordinary share capital, the parent have 75, subsidiary has 25, preference share parent has 40, subsidiary has what? 60. So have it there like that. Then note 2, I look out for my investment income. So now if I say investment income, you already know what constitutes investment income. Then note 3, I adjust my debtors by adding my investment income to the debtors. I also adjust my surplus by adding it to my surplus over here. Then I have unrealized profit. I've also explained the circumstances underlying unrealized profits. That you must know who is selling to who. When it comes to unrealized profit and you don't know who is selling to who, it creates a problem. So if the parent is selling to the subsidiary, there is a way to treat it. If the subsidiary is selling to the parent, there is a way to treat it. And so therefore, it's your duty to also go and understand and know that this is how it is treated. Now, when the parent is selling to the subsidiary, all the unrealized profit is debited to the consolidated income surplus. And when the subsidiary is selling to the parent, then the unrealized profit is going to be debited to the consolidated income surplus and the minority interest account based on their percentage holding. Case closed. No further explanation. Then you prepare your cost of control accounts. So these are your cost of control account to look like. And I've explained in our earlier discussion that the investment value that comes here is that of the equities. So when you look at your additional information, 1, you were told how the investment was made. 40,000 in ordinary share, 4,300 in preference share, 5,000 in debentures, and that gives you the total of 53,300. So when you are bringing 53,300 here as your investment, you are wrong. So you should know that the equities are what comes there. That's the 44,000 and then the 4,300. And then you proceed. Then the pre-acquisition surplus here, it is the ordinary share that entitles you to control. So it is the percentage of the ordinary share you use whenever we are talking about surpluses over here. So you have to take note over there. Then the unrealized profit, as I was talking about, it is the subsidiary that is selling to the parents. So you share it to them in the ratio of the percentage holding. This is how your income supposed to look like. This is how your non-controlling interest account will look like. And based on that, you prepare your consolidated balance sheet. So goodwill, tangible assets, stock, trade debtors, cash in transit, cash at bank, in that order. So you can just take snapshots of them, compare with your solutions. I'm just giving it to those who have tried their hands on and wanted to know what they did is right or wrong. As for those who didn't try their hands on it, they are not my friends. So I will not do anything for them. So this is how your solution will look like for that particular assignment too. Then which one again we talk about? Which one again did they send to me? So that I can talk about it briefly before I end my Zoom session. Then, yeah, somebody also asked me a question connection with the price level accounting. I think that one we did it in class, so I'll not waste much time on that one. But this is basically what we did in class. So the one that they said Serious Ghana was incorporated, blah 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 blah, and then on 31st January there was a sales 200 bags. No, there was a 400 bags costing this. Then they replaced the bags again. 28th February they sold this. 31st March they sold this. So this is the historical cost for that one. Then we already know the CPP factor here, 240 over 220. This one to 240 over 230 to get the CPP values over here. So basically, we know that this conversion factor is equal to what? The reporting date index over transaction date what? Index. Then you come and look for your cost of sales. So how much did it cost me to sell the items here for 200,000? Then you are being told that. So based on that, I told you that we use the FIFO method of distribution. So the first purchases that came is 500, second purchases that came is 400, next purchases that came was 50, the next purchases that came was what, 100. So the first sales, we took it from where? Here. I decided to use the same colors so that I see. Now the first 400, this 400 was took from here. When I took this 400, how much was left? 100. Then these sales came in, these purchases came in. The total is 500 now. The next sales, the person wants 200. So I pick 100 from here to clear this 500. Then I pick 100 from here to clear this particular 100. So you should play with 300 there. So the second 200 that I sold for 10,000. That is how I took it. In that order, the person wants 200. So I'll pick the same 200 from here for this particular sale. So when I come here and I say 400 divided by 500 multiplied by 7,500. The historical cost is 6,000. Here 200 divided by 500 multiplied by 7,500. Historical cost is this. 200 divided by 400 multiplied by this. I get the historical cost to be this. In that order, then I come and do my conversion factor or my CPP factor to get my CPP here. So historical cost sales, CPP sales, historical cost of sales, CPP cost of sales are adjusted over here to get your profit statement. So that is basically how the enterprise W's a Serious Ghana question in the handout. That is how it is being presented, or that's how it will have presented my goal. So that's the next question. Somebody also asked me that he or she need further clarifications on that one, and then it is. Then they also ask some questions on the theories. As for the theories, every day, every blessed day, they ask you in class. They come and ask you what is control. They ask you wake up, stay, and this. So I don't think those things should be things that you should be asking a question of them as we speak today. And and go through your past questions to very well. Okay, go through the past questions and at least solve the sample questions you are seeing over there. It gives you a fair idea on whatever you should be expecting in the exams. And you see me, I've been telling you in class that The questions that you are going to write in all the subjects are not questions that are going to come from space. The lecturers will give you things within your remit, things you can do. So when you learn well, at least you solve the past questions, you are at least ahead of somebody who have not even seen the past questions at all, and he or she is going to write the paper. You understand? So you have to look at the past question and solve the question. Then you see that, oh, this is how they can frame this particular question too. I get this. Because nobody will come and ask you what are the elements of control. Nobody will come and ask you. It's so straightforward and direct. Nobody can come and ask you, list the items in director's reports. No, they are so straightforward and direct. But it will be framed in a question. It will be framed very well for you. I get it. When you look at the past question, that's how they frame them. So the questions are well structured. So when you reason very well, you know what they are trying to ask you to do. Okay, so I'll leave you here, and then I'll wish you all good luck. But let me see if I can have this particular one today. I can just take it and then explain it. Yes, let me just take it over here. That enterprise topic question. Yes, so this question we solved it in class, and then there is one in the past question that you were being told that the interest on loan, the interest on the loan, this loan that was taken, the interest on the loan is 10%. And then I was explaining that you should know that the loan is 100,000. So the interest on the loan is how much? 10,000. So once you know the interest on the loan, two things are involved over here. You can be asked that the interest on loan is paid at the end of the year. So let's assume the interest on loan is paid at the end of the year. So what it basically means is that if I come to my cash flow statement over here, yes here, after 31st December, I'll just put here interest or before 31st December, or on 31st December, interest on loan. The historical cost, 10,000. CPP, 10,000. Why? CPP is also 10,000 because the CPP factor here is going to be 1 because I'm making the payment on 31st December and the December 31st also happens to be my reporting date. That's where you are being told that the interest on loan is paid semi-annually and the rate is 10%. You should know that you do 10% of the 100,000 divided by 2. So 5,000 for one half, 5,000 for the second half. That is for historical cost. And then, so 30th June, there's 5,000. 31st December, 5,000. So for the 30th June CPP, I'm going to use the 30th June CPP 858 over 780 multiplied by 5,000. Then I get the CPP for that one. So when I go to 31st December, it is still going to be 5,000 because the transaction date and the reporting date are 1. So the total interest on loan now will be appearing in my profit and loss here. Total interest on loan that will be appearing in my profit and loss here, just under expenses here. For historical cost is 10,000. For CPP is going to be 10,500. And then case close. So basically, that is the only twist I see the past questions as far as this particular illustration here is concerned. So we did it in class. The solution is here. You can look at it as a guide, and based on that, you just solve the ones you see the past questions to see if you are able to do that. So wish you all the best of luck and pray that you all go and come out with flying colors. Nobody should go and engage him or herself in any more practice, because when you do, caught, and once you are caught, be sacked. So please and please and please again, don't get yourself involved in any form of practice. Go and do your best and you pass. Good night.